It's Saturday, January 16th, 2022. This is all about your Benjamins and your weekly mixtape and weekend review. And I know we're a few weeks into the new year, and this is the first weekend review video, first mixtape of the new year, and I want to welcome you back. I want to apologize a little for not having one prior to now, but as I'm going to write about here in the coming weeks, I took the end of the year, we took a vacation to Dominican Republic and really just kind of disconnected and slowed down. And coming into 2022, my three words for the year are self, simplification, and slowing down. And ultimately I realized that a few weeks could go by without a mixtape, everything would be okay, and get back to it, have a regular schedule, and really get focused and excited about the new year. So here we are, we're back. Also have to apologize real quick about being all up in your face today. I left my normal lens back at the office, so the lens I have at home today, this is what we got to work with. So apologize for being right in your face. Hope you're having a great beginning of the year. As you can see, there's a few headlines down below that we'll get to. So let's get to the headlines that may or may not be impacting your financial plan and portfolio, and kick 2022 off middle of the month with the first weekend review video. So let's get first to inflation. So really, two main topics this week that we'll really kind of hammer home on: inflation, and then we've got COVID still out there and things along those lines. So first one is inflation hit 7% back in December. That is high. We've talked about the goal for the Fed is to keep inflation at 2%, so we are well above that right now, and it's been that way for a little while. This is not the first time we've talked about inflation rising. It was 6% before. Supply chain has been one of the things that has been a hope for the cause, and the reason I say hope for it is if supply chain really was driving the cost and the expenses of the inflation going up, then when supply chains got fixed, the theory was this would come back down. Transitory was the word that Federal Chairman Powell was using when he would talk about inflation. It's been here with us longer. This is the third consecutive month of 6% or higher inflation. So we'll have to see how much of this is transitory and how much of it is here to stay. But nonetheless, higher inflation, which is going to spark some conversations from the Fed. It's also going to be kind of, what do we do to combat inflation? People start talking about the 70s when it was real high. I saw an interesting stat that the last time inflation was at 7% or so in January, and I think this was back in the 50s, the tweet I saw was, look to see what the next year was of inflation. And the next year was like 1.2%. Now, past performance, history doesn't guarantee what's going to happen in the future. More of kind of an interesting perspective of just, we've had spurts where inflation's gone up and it comes back down. We've had it last longer, so we don't know. I want to take this moment as a reminder to remind you that the reason we invest, the reason you have equities in your portfolio is to combat inflation. So this is why we invest. Yes, we want to see our money grow, we want to see it compound, it's all important, but the reason we need our money to grow and compound is to keep up with inflation. The other thing I want to kind of bring in as we talk about inflation is I would have to go back to check the records. I haven't talked about it a lot, but in the past when inflation was low for so long, and I have this conversation with my retirees who retired in the last 10, 11 years, were very, very fortunate, and luck is a part of every financial plan. They retired into a relatively good market, and they also retired into a relatively low inflation environment, 1%, 2%, for an extended period of time. So their pensions, their Social Security, combine that with a good stock market, they may have retired into one of the best periods to start a retirement. Going back to low inflation, there's this concept called reversion to the mean. Shout out to my friend Kevin. We used to have a podcast called Reversion to the Mean, and basically what the reversion to the mean says is that there's an average. Inflation has historically averaged 3%. If we've been riding below 3%, and this is the same for investment performance as well, if we've been riding inflation well below 3% for a number of years, then eventually it's got to come back up to 3. And if to go from 1 as an average to 3 as an average, you don't just have 3%, you've got to go above that 3% to bring the average up. So reversion to the mean means if we've been averaging lower than 3% for an extended period of time, we've got to spend some time above 3% to get us back to that historical average. It's a concept, it's never always 3%, but the point of that is we knew eventually there would be inflation, it would go above 3%, here we are. Now it's just how much longer is it going to last and what impact does it have on the economy and the market and our financial planning. One of the things that's been happening with this inflation that has been a positive in some sorts that kind of it won't equal it out, but kind of mitigates how much inflation's eating into is wages are going up. So wages going up combined with inflation lessens it a little bit, but it still hurts when you go to the grocery store and see you're spending 20 or 30% more, or you go to the gas station and you see gas here in Indy's around $3.50 or so. So we're definitely seeing it, we're definitely feeling it. I don't know how much of it is hitting the consumer's pocketbook quite yet, but eventually it will. And also, the more we talk about it, psychologically, it's going to impact people as well. So it becomes a self-fulfilling prophecy also. So inflation 7% in December, third consecutive month at 6% above. We'll have to see what's going to happen. That brings us into the next one. Chairman Powell talks about how the economy does not need aggressive stimulus anymore. So they're talking about beginning to raise rates, but they want to do that carefully because raising rates impacts everything. Cost of borrowing could help our savings earn a little bit more, but it impacts investments because as rates go up, it's more expensive to do business. That eats into profits eventually for a period of time. That impacts stock prices for a little bit. That comes on to the consumer eventually. That price increase comes to us, and it kind of settles itself out. So Powell says they are prepared to raise rates if they need to, but they are hoping still that some of this inflation goes away when supply chains open up and things kind of resettle to pre-COVID life. So we'll have to see this, but the Fed is ready to raise rates. Expectations are that they will a few times this year, so we'll see that. We'll be talking about it more when it happens. Next article talks about the beginning of the year. There was a bond sell-off, and I wanted to touch on this because for most individuals, the reason we hold bonds in a portfolio is for protection, downside protection. When stocks go up, bonds kind of hold flat. When stocks go down, our bonds are supposed to kind of provide us a dampening to the decline. It's supposed to be inverse relationship. And for most of the time it does, but every once in a while they kind of go together. Well, beginning of the year we saw interest rates going up, which is not good for bond prices, or bond prices going down, which drives interest rates up, however you want to look at it, chicken or the egg. But nonetheless, we saw bonds have a tough beginning of the year, and we saw this back when COVID happened. Not to get into a bond lecture, but you have different lengths of bonds, short, intermediate, long-term bonds. When rates go up, bond prices go down. And the longer the term of the bond, the more sensitive or more impact they're going to see to the price. If you think about it, if you're holding a 30-year bond and rates go up, that means you have to wait 30 years before you can get your money back to go reinvest in these higher rates. That's not a good thing. It's going to cost you more today to get out of that bond. Short side, that means they're turning over more quickly so they can get reinvested back in rates as they go up. So if you're anticipating rising rates, short term is usually where you want to live. They're less sensitive to that rising interest rate. And because of that, they're supposed to be the more conservative option. But back in 2020, when COVID kind of went out, we saw short-term bond prices fall as well. So nothing, and we know this, nothing is immune from risk. Nothing is immune from going down. I just bring this back up because there is the potential to see your safe, quotes, safe part of your portfolio decline in the coming year, because if rates are going up, bonds may go down as well. And depending on the bonds that you're holding, they may be more susceptible to a decline as rates kind of readjust. So just prepare for that. Hopefully things are okay everywhere else in the economy, so that bond prices are going down in the short term. After a little initial shock to the stock market, your stocks are coming back up and kind of counteract. So again, I think it's good to be prepared to see that part of your portfolio in the short term potentially have some volatility. And that's why you have a plan, that's why you have an income strategy plan, and there's other things that you can do as well to kind of make sure your income needs are there if you need that. All right, let's go to some economic data real quick and then we'll wrap up. Retail spending towards the end of the year slowed down. I wanted to put this in here because I saw the article and I was reading it, and they're attaching it to Omicron and COVID and potential shutdowns and things of that sort. But I also didn't know if I don't have the data to be able to see this, but I'm also wondering if part of the sales slowed down in December because so many people were shopping for Christmas ahead of time. There was a lot of advice out there that if you were going to be having orders shipped to you for Christmas, you needed to start buying in September and October and November because of the supply chain issues. So some of those December sales that we would have normally seen through retail spending could have been pulled forward into November, October, and September. So the article wasn't necessarily pessimistic about it, just stating the numbers. So we'll see kind of if spending picks back up in the new year or how things play out. And then finally, DC, we've got a mandate attempt to make sure that every business with more than 100 employees mandates a vaccine against COVID, and that was shut down by the Supreme Court. So there'll be some political things coming on. I know there's the Build Back Better bill that's still waiting to be passed, and some other things going on in DC. Short term, as usual, reactions to it in the market typically, but it's worth paying attention to, and that was one that kind of was a big topic this week. So that is it for this week. I know I went on a little bit more tangent and kind of got into some technical things when it comes to the bonds and things of that sort, but I felt like it was warranted. Plus, I was really excited to do today's mixtape, so as I get excited, the more I talk. Before we wrap up, I just want to plug a couple things. If you have not been paying attention, every Friday I'm recording a show on All About Your Benjamins called The Pursuit. The topic of The Pursuit is following your passions, how to incorporate that into your life, why you should be doing that, and also how it fits into your overall financial plan. I believe that we have way more control over our destiny than we might have been told. We let the limitations of others limit ourselves, and I want to try to break that mold. So if you are interested in following your passions and creating a life that you really enjoy, minimizing regret, you might want to check out The Pursuit. I think that podcast may resonate with you. This week I have my dad, who is a new hire at RLS Wealth. He retired at the end of the year. He is now our Chief People Officer. I will be officially announcing that here pretty soon, but he was on the podcast with me, and I think we're going to launch a new podcast show on All About Your Benjamins. So think about All About Your Benjamins as the brand and as the show and as the channel. So not a show. All About Your Benjamins is a channel. We've got The Pursuit on Fridays. We're going to call it The Next Episode, and I think it's going to be a bi-weekly episode, maybe on Wednesdays. More will come, but it will be focused more on my dad, his journey into retirement, what he's learning, how he's finding himself, how he's focusing on himself in this new chapter, or as he explained in this week's episode, his new book. So that will be coming, and also going to be reaching out to guests and have them come back on All About Your Benjamins and talk more financial planning. I want to get back to making All About Your Benjamins financial literacy, education, what it was when it first started, bringing that back to the table as well. As I've talked about on The Pursuit, making some changes in my life to free me up to be able to do more content, because that is one of my passions, one of the things that really lights me up and I really enjoy, and I hope that it's beneficial. So finding more time to do that for me, but also hopefully benefits everybody out there. So All About Your Benjamins will become more active. And finally, if you're interested in pursuit type stuff and passions, I've been participating in a Ship 30 cohort. So the concept is write 30 atomic essays, which are 250 words or less, 30 days in a row. And I've been writing about this concept of passions and talking about sparks, if you've ever seen the movie Soul. So 30 days of essays about that. I'm actually writing that on my other blog at justincastelli.io. I will probably pull together a summary, or maybe putting all these together into one major document, and I'll bring it to All About Your Benjamins in the future. But I wanted to write it on my personal blog because it was more of a challenge to myself and personal experiment rather than something I felt was for All About Your Benjamins. But justincastelli.io, you can head over there, and they are all consecutively linked together, evolving. I'm going to start hitting into how we take our passions and our sparks and bring them to our planning here pretty soon, which will go into the future of financial planning. So I've got this process I want to take us through on those 30 days. So that is it. So make sure to go over to justincastelli.io if you are interested in the pursuit and passions and kind of following those and how to incorporate that in your life. So I appreciate you sticking with me. This was longer than normal, but wanted to get those things out there as well. So with that, I'll let you get to your weekend. Be sure to check the mixtape down below. This week's mixtape is a compilation of blog posts I've been sending to my Notion over the last few weeks, rather than just from this week. So I've been preparing to do the mixtape and then just not doing it over the last couple weeks, but this will be back and be regular. What Ship 30 is helping me do is get consistent and be regular with these things so that I can be there when you're expecting me to be there. So with that, have a great weekend. Appreciate you tuning in. If you're on YouTube, head to allaboutyourbenjamins.com. I'll make sure to put the link in the comments below to take you there quicker so you can see the supporting articles and the mixtape. Appreciate you tuning in, and we'll see you all in the next episode.